Hello everyone, I'm Zihan. Here's my crew members, Yunan and Zhao Ye.
The foreign exchange market, also known as the forex market, which is the world's largest financial market. It has an average of more than $1 trillion of funds circulating in it each day, which is equivalent to 13 times to total US market transactions. Forex trading is the simultaneous purchase of one of a pair of currency combinations and the sale of other currency. Forex is traded in currency pairs such as euro and US dollars or US dollars Japanese yen. There are two main reasons for foreign exchange market trading. About 5% of daily trading turnover is due to companies and government agencies buying or selling their products and services abroad, or they must convert the profits they earn abroad into the national currency. The other 95% of transactions are for benefit or speculation. For profit-oriented investors, the best trading opportunity is always to trade the most commonly purchased currency, which is called the primary currency. Today, as FX traders within my company, I would like to choose US dollars and Japanese yen based on the following trading strategy. To consider the American and Japanese interest rates relatively, inflation rates, relative growth rates, government intervention, and exchange rate expectation. The basic factors affecting the changes in exchange rates, which are believed that the basic factors affecting the exchange in bilateral exchange rates are mainly in the following 7 areas: economic growth rate, current account balance, interest rate, relative inflation rate, market expectations of exchange rates, and government policy. Economic growth rate. The Japanese economic growth rate is weak, which will affect the Japanese yuan exchange rate. US GDP growth will rise to 2.7% in 2018, which is according to the most recent forecast released at the Federal Open Market Committee meeting on March 20, 2018. In the December ESP forecast, the consensus forecast for real GDP growth averaged from the predictions of 41 economists polled by the Japan Center for Economic Research, were 1.84% for the fiscal year 2017, and in March 31, 2017, and 1.22 for fiscal 2018, Takumori 2018. Apparently, US GDP growth in 2018 is more significant than the Japanese. If the country's economic growth rate is relatively high, especially export-led economic growth, which will be resulting in higher demand for local currency, then the local currency will appreciate going to increase. However, as for FX trader, that I believe that in the short term, if the country's economic growth rate is high, the local currency will depreciate due to the higher foreign exchange demands resulting from the more top marginal importation. Japan's current account balance fell to Japanese yuan 208 trillion in February of 2018 from Japanese yuan to 91 trillion in the same month. A year ago, my market estimated a surplus of Japanese yuan to 16 trillion. The US current account deficit increased to US dollars 128.2 billion. Interestingly, the US current account balance is also higher than Japan. If the current domestic account shows a surplus, the local currency will be influenced. If the current account shows a deficit, the local currency will depreciate. The interest rates. U.S. The Federal Reserve meeting for the first time under Chairman Powell raised the target range for the federal funds rate by a quarter point to 1.5 to 1.75% during its March 2018 meeting. The Bank of Japan left its key short-term interest rate unchanged at minus 0.1% in its March 2018 meeting, as expected. The higher interest rate can increase the value of a country's currency. Interestingly, the higher interest rates tend to affect the foreign investment, which is increasing the demand for the value of U.S. currency. Therefore, to consider the recent data, the Japanese low interest rates tend to be unattractive for foreign investment and increase the currency's relative value. Relative inflation rate. The consumer prices in the United States increased 2.4% year-on-year in March of 2018, which is above 2.2% in February and matching market expectation. Compared with Japan, the consumer prices in Japan rose by 1.5% year-on-year in February of 2018, after a 1.4% gain in the prior months, while markets estimated 1.7%, which is under the market estimation. The low rate of inflation cannot guarantee a favorable exchange rate for a country. However, the extremely high inflation rate is also influencing the country's exchange rate. Market expectations of exchange rates. The market's expectation of the exchange rate have an impact on the short-term trend of the exchange rate. If the market expects the local currency to appreciate, the local currency will appreciate in the short term. To consider the above data set, all the information about Japan are under the market expectation, which will directly affect the current exchange rate of Japanese yen.
The central bank's foreign exchange intervention. A country's central bank may take certain interventions on the foreign exchange market when it is needed. These measures will have short-term impact on the exchange rate changes. In summary, the long-term trade of the exchange rate depends on the fundamentals of the economy, and the short-term trade looks at the market and returns on the government policy. At the same time, it needs to refer these actors such as market expectations and central bank intervention measures on the current situation of US and Japan. To analyze the future trade 3 to 6 months of the exchange rate from the personal and professional perspective, I believe that the US exchange rate will increase and that Japan will decrease. Secondly, it is to microscopically use the technical analysis method to predict the possible range of next exchange rate. The former is mostly used in the decision-making, international trade, and international direct investment, while the latter is mainly used in foreign exchange market trading and other forms of foreign exchange transactions. From the above figures and data, the long-term Japanese yen exchange rate against the US dollar is still facing downward pressure. This is because there is no fundamental change in the trade of the current account balance between the United States and Japan, and the low inflation rate in Japan may continue for a long time. Moreover, from this perspective of economic strength, the Japanese yen may be underestimated. If such an underestimation exists, then the free floating market will gradually correct such underestimation and restore it into normal. This will also encourage Japanese yuan to continue going down. In the medium term, the Japanese yuan will still maintain its relatively steady downward trend. But the figure shows that this is because Japan's relative inflation rate to the United States will continue the current situation for a long time. Also, due to the diversification of reverse assets and safe haven assets caused by the financial crisis in recent years, the demand of hedging against the Japanese yuan has increased relative to the safe haven demand for the US dollar. This will also cause the JPY to continue under the estimation. However, the current Japanese interest rate is relatively lower than that of the United States, which is a resistance to the continued appreciation of the Japanese yuan. Under this resistance, the appreciation of the Japanese yuan will undoubtedly be slow, and small fluctuations may be more frequent. The production of medium and long-term trends can be attributed to the fact that Japanese yuan exchange rate against the US dollar will continue to be in the current situation unless there are significant political and economic events like the Plaza Agreement or the international financial crisis.